Okay, so in this video, we're going to look at these business transaction examples and actually go through and show you how to record them in a general journal, following all the steps that we need to follow. So, this example is on January 1st, Mr. John introduced a capital of $30,000 from his own money and deposited it in the bank. So this is, again, that first initial transaction for the forming of the business. So Mr. John deposited $30,000 from his own personal money and invested it into his business and directly into the bank. So step one, is the analysis, where we're going to identify the accounts that are being affected. So we know with this $30,000 deposit, cash in the bank is going to be affected. And since this is a $30,000 investment towards his business, Mr. John's capital account is also going to be affected. Cash in bank is an asset account. Mr. John's capital is an owner's equity account, and cash in bank is going to increase. John's capital is going to also increase. So then we apply the debit credit rules. Debit, we're going to increase cash in bank, we said. So cash in bank as an asset account will increase on the debit side. And Mr. John's capital account is going to increase on the credit side. So you can see they already have the T accounts prepared as well. So here's our cash in bank, which is an asset, increasing on the debit side. Mr. John's capital, which is our owner's equity account, is increasing on the credit side. So we have our debit and our credit. So then I'm actually going to do this. So now we have everything analyzed, and we're going to post it to the journal. So we have our journal page over here. I have it kind of simulated in this Excel document. So on January 1st, we're going to list the accounts affected in this column with the under account title. And like I said before, we always want to list our debits first. So we're going to debit cash in bank for $30,000. And then we list our credit next, and we're going to credit Mr. John's capital for $30,000. And we said on the third line that we want to have some sort of source document in this line here. So if it doesn't say anything, tells us memorandum number 1. So you typically in the transaction itself in this class, it will tell you like receipt number, memorandum number, so on and so forth. And this time it just didn't tell us, but it shows us down here that they used memo number 1. That's our source document. So that is one complete transaction in our general journal. We have our debit and our credit. We're balanced out, 30 and 30. Okay, because at the end of all of our business transactions, our debits must equal our credits to show that we entered everything in correctly, because this is all part of the double entry system. All right, let's look at the next example. On January 2nd, Mr. John purchased a computer for his business for $500. He used a bank check for the transaction. So he wrote a check from his bank account for $500 to purchase a computer for the business. Okay, so analyze the effects on the accounts. We're going to use an office equipment account and a bank account. Office equipment is an asset, bank account is an asset. Office equipment is going to increase $500 because we purchased the computer, so the value of the computer is $500,000. And then our bank balance is going to decrease because we wrote that check, taking that money directly from our checking account. Apply the debit credit rule. We're going to increase, we said, the office account with a debit. Then we're going to decrease our bank account with a credit. So looking at our T accounts here, we have office equipment increasing on the debit side and our bank account decreasing on the credit side. So we will record this transaction into our journal. We record our debit first. Office equipment for $500. Bank account is getting credited for $500, and they should give us a check using the check stub for verification. So we list that there, and that is our second transaction. Moving on to the next one. On January 10th, X business bought a truck from Y business for $10,000. Invoice number 500. So this was on January 10th. Okay, accounts affected. So they're recording this purchase of a truck in their delivery account. So that's an asset account for them. It's something they own. They own this truck, and they have an account called delivery account that they are recording that transaction under. Then they also have an accounts payable account because it says bought a business from truck for $10,000 invoice number. So that means we received an invoice from the company that we purchased the truck from, Y Auto. We got an invoice. So that means that we're going to be paying this amount later. If it said receipt, that means we made the payment right away. But since it's an invoice is like a bill saying we owe this amount of money. Okay, so it's going to affect our accounts payable, specifically Y Auto account. Delivery account is an asset, accounts payable is a liability, and both accounts are going to increase by $10,000. Let's look at the debit credit rule. An increase in our asset is recorded as a debit. Increase in accounts payable is recorded as a credit. And here is our T account set up for us. Increasing on debit on the left side of our delivery account and increasing as a credit on the right side of our accounts payable. So we will record that transaction. We want to do our debit first, so delivery account for $10,000, and then our accounts payable Y Auto. And we always need to make sure that we have, as a company, we're probably going to have many accounts payable, and so we always need to make sure we add on which account or which company we're talking about. So accounts payable to Y Auto, amount of $10,000. So that should match up here. And we have the invoice number that we need to record, 500, as our documentation. Next example. And you'll notice with this one, you've heard me mention before that you're going to find some kind of weird errors throughout the text, and this is one of them. So I think they just got their dates mixed up, so we're going to change this previous one to January 9th and make this current one January 10th. So just kind of a typo in the text there. Okay, so on January 10th, X business sold one computer on credit to Rex Company for $500. So sold one computer on credit. So that should all be kind of signals to you on which accounts that we're using. So the accounts affected, we sold it on credit to Rex Company for $500. So our accounts receivable to Rex Company is going to be affected, and because it was some of our office equipment, that's going to be affected as well. Both accounts are asset accounts. So our accounts receivable is going to increase by $500. Office equipment will decrease by $500 because we sold it. Our debit credit rule, accounts receivable will increase on the debit side. Office equipment will decrease on the credit side because they're both assets. And we record that transaction into our journal. Account receivable to Rex Company, $500 debit. We sold office equipment, $500 credit. Memo number 3 takes care of that transaction. Okay, next one. On January 11th, X business mailed check number 307 for $600 as a first installment of the truck purchased from Y Auto on January 10th, or we changed it to January 9th. So we are mailing a check for a first installment payment. So we're making a payment on this truck that we purchased from Y Auto for $10,000. All right, so the accounts are going to be affected. We're making a payment, so it's going to be accounts payable. And since we are making a payment of $600, it's going to be taken out of our bank account. Y auto is a liability account. Bank account is an asset account. Accounts payable is going to decrease by $600 because we are paying $600 on this $10,000 that we owe. So it's going to decrease the amount of money that we still owe once we make that payment. And then our bank account is also going to decrease by $600 because that money is coming out of our bank account. So here's what our debit credit rule looks like. Accounts payable is being debited. And actually that should be decreasing on the debit side. So another one of those errors that we're going to find because we said accounts payable will decrease by $600. So again, it's a debit to our accounts payable, but that should be a minus sign instead of a plus sign. And then it's also going to be subtracted from our bank account or recorded as a credit in our bank account. So we will copy that information into our journal. Debit first, so we are going to debit accounts payable Y auto for $600, and we're going to credit our bank account for $600 as well. This is all verified on check number 307. All right. Okay, another little checkpoint for you to complete to make sure that you are staying on top of the terms and the concepts and everything. Make sure you fill these out just because it will help you with like how the quizzes and exams are structured. Okay, journalizing a business transaction. The next example, on January 13th, X business received check number 308 for $400 as payment for providing services to Ronaldo Company. The check was for full payment. So we're paying for the whole thing at once. We don't have to worry about accounts receivable. Accounts receivable, because we are receiving this check from Ronaldo Company for services that we provided. Okay, so in this account, the accounts that are going to be affected is they wrote us a check for $400, so that's going to go right into our bank account. Then it's also affecting our service revenue account. So we talked about revenue accounts in the last unit, at the end of last unit. So this is going to affect our revenue account. Bank account is a asset account. Service revenue, since we provided service and that's what our business does, it's a revenue account. Bank account is increased by $400. Service revenue account is also increased by $400. And when we go to apply those debit and credit rules, you'll remember that a credit or a revenue account is increased on the credit side of the T account. Bank, of course, as an asset is increased on the debit side. So we're increasing both accounts. Our debit is going towards the bank account and our credit is going towards the service revenue account. So again, this happened on January 13th. January 13th, we have our bank account being debited and our service revenue account being credited. We received the check for services. Okay, and of course our check number 308. All right, January 15th, X business paid $200 for electricity charges with check number 202. So, accounts affected, electricity expense. So we talked about expense accounts along with revenue and withdrawal accounts. So this is affecting an expense account and our bank account. Electricity expense is an expense account. Bank account is an asset account. And both electricity expense is increasing. So it's money going towards our electricity expense, so it's increasing. And it's money coming out of our bank account, so it's decreasing by $200. Apply the debit credit rule. Electricity expense account increases on the debit side, as we know. So it's going to be recorded as $200 in the debit column. Our bank account is going to decrease by $200, so that is recorded as a $200 credit to our bank account. And this happens on January 15th. January 15th, we have our debit first, electricity expense for $200, bank account being credited $200 because it's coming up. Okay, double check here, and it was check number 202. Good to go. Next example, January 15th, so on the same day, our business provided service to Max Company for $500. Sales invoice, $5. So it's an invoice, meaning it's a bill that we will receive payment on later. Okay, that's what the invoice means. So, accounts being affected, accounts receivable to Max Company, that's who we provided the service for, and our service revenue account will be affected because it's the service that we provided, that our business provides to, and we provided it to Max Company. So accounts receivable is an asset account, service revenue is a revenue account. Accounts receivable will increase because this is an increase on the amount of money that is owed to us, and service revenue will also increase. All right, accounts receivable will increase on the debit side, service revenue will increase on the credit side. And we will need to then record that into our journal, January 15th. Accounts receivable from Max Company, increasing by $500. Service revenue, also increasing by $500. This is recorded on sales invoice number 5. So hopefully you guys are getting the idea here. I don't want to drag this video on too long. There's a couple examples left that maybe you should try and fill out on your own. And then your text talks about correcting errors in the journal. So there's a certain way we need to go about correcting those errors in our journal. So if an incorrect account name is given for a particular account, the accountant should strike through the name and write the correct name above it. This type of correction should also be done when the journal entry is not yet posted to the ledger account, which we haven't done yet. That'll be something we'll cover later on. So, for instance, when we had this check number 105 that we made for our electricity charges, I think we recorded. Oh no! So I thought this was going to refer to one of the transactions that we recorded, but this is kind of its own thing, just as an example. So, for instance, here's the example. We wrote a check for number 105 for $200 for electricity expenses. And instead of debiting the electricity expense account, the account was incorrectly debited to the rent expense account. In addition, the amount was misrecorded as $300 instead of $200. So this is what it looks like when you fix a correction. You're just striking through it once and then writing the correct information on top. Because, read this note down here, the accountant should not erase the incorrect account name or amount, as it might be perceived as an attempt to conceal a mistake or changing the account illegally. So you just want to strike through once so that people can see, okay, well, what did they do before? What was the mistake? Oh, they had it in the wrong account for the wrong amount. Here's the correct information above. Because if you're erasing it, that could be a suspicion that you're kind of trying to change things unethically. Here are some key terms that we mentioned while we were reading through this unit or this section. So be familiar with these terms and be ready to see these on the upcoming quiz. And that is it for this video. We will be completing this assignment together in the next Class Connect session, so be sure to stay tuned for that. And you should be prepared now to go take the quiz. So good luck with that, and let me know if you have any questions.